You've heard it before. When the markets become erratic or seem poised for a prolonged downturn, the best thing you can do is nothing at all. But if you're on the cusp of retirement, or perhaps worse, newly retired, a turbulent stock market can make you feel particularly vulnerable. My guest is David Foster with Asset Protection Professionals in Winder, Georgia. So it's been said that market losses or corrections are actually worse for retirees. Why is that the case?
Yeah, primarily the three major risks in regards to retirement are longevity risk. Will my money last me long enough, right? Two, sequence of returns risk, and three is more than likely a health risk occurring later on down the road in their 70s, 80s, and 90s.
So David, explain sequence of returns risk and why it's so important.
Yeah, sequence of returns risk. A good example of that would be 2008, where all of a sudden if you had $1 million, it turned into around 600,000. You're stuck to what's called a safe withdrawal rate. So typically whenever you're taking money out of your accounts in retirement, if that account value drops drastically like that, or a sequence risk, all of a sudden your income will drop, right? Because you're still stuck to that safe withdrawal rate.
Now, traditional safe money options have been bonds and CDs, but they aren't as attractive right now. What other options are there?
Yeah, in my opinion, I think a great option to look at in regards to your more or less the fixed assets of your portfolio are things like life insurance and annuities, specifically fixed index annuities as well. Primarily, it just depends on what you're trying to target, right? Are you trying to preserve an asset that's already built? Are you trying to receive income off of an asset? Or are we getting together early enough in the journey to be able to continue building over the next, the back end of your career?
That's David Foster with Asset Protection Professionals in Winder, Georgia. And this is Retirement News Online.